Let's bring in Ed Yardeni of Yardeni Research. Welcome back. I mean, it's one thing to be bullish, but that's like off the charts bullish. Why so?
Well, I don't know that it's really off the charts. It's actually consistent with the underlying trend of earnings and the stock market for years. Every now and then we do get these recessions and corrections. We certainly had a bear market last year. It was a fairly conventional one with a 25% drop. Then we made a low in October of last year, and we're up substantially since then. We had a conventional correction during the summer, and now since October 27th, we're back in what I think has been a bull market since the year before that. And I think the economy's proven to be resilient. I didn't buy the idea that it's going to fall into recession. It's been more of a rolling recession. But earnings are about to hit an all-time record high, and I think next year's economy is going to get a big boost from productivity. Everybody talks about AI and all the other technologies. They're all out there to increase productivity, and I think that's what's going to happen.
Yeah, I mean, I'm looking at your targets, right? 2024 year end is 5,400. 2025 right. Year end, it seems hard to look out that far, but nonetheless, 6,000 on the S&P. I mean, so the implication here is that this isn't just a bull market. This is a new, very powerful bull market that we've started.
Yeah. Well, I've been discussing the alternative scenarios for the decade since the beginning of the decade. In 2020, I said, look, it's either going to be a repeat of the great inflation of the 1970s, or it could very well be something more like the 1920s, the roaring 2020s. And I'm increasingly convinced that it's going to be the roaring 2020s with technological innovations solving the major economic problem we have right now is labor shortages, skilled labor shortages. Productivity, I think, is going to be growing 3.5% to 4.5% within the next couple of years, within this decade. And that may sound far-fetched, but that's the kind of peak you usually get in the productivity, the last 3 productivity booms we've had. So historically, it's possible, and I think this productivity boom that I see has more going for it in terms of the ability of technology to really apply to almost any business. I think any business these days is a technology company. They either make it or they use it. If they don't use it, they're going to be at a competitive disadvantage.
How many Fed cuts do you think we get next year?
Well, again, I'm not in the recession camp. I see there's still some what I call die-hard hardlanders out there that are still expecting recession. I don't think we're going to have a recession. In that case, I think the Fed is going to cut rates twice, not 4 times or more, which is what those who are looking for a recession expect. Look, I think the reason the Fed's going to be lowering interest rates next year isn't because of a recession. It's because inflation is going to continue to surprise everybody and come down substantially. We've been in the camp that has argued that inflation could turn out to be relatively transitory after all, and it's certainly come down a lot faster than has been widely anticipated.
What are you worried about, if anything? I mean, rising deficit, not even rising. I mean, it's like out of control, right?
Yeah.
Many would describe it as.
Sure.
The cost of funding that, messy election.
Right.
What, if anything, worries you?
Well, look, I pay close attention to the bears and the pessimists. They've done an outstanding job of telling us everything that can go wrong. Just they haven't been balanced and suggested what could go right. And yeah, I'm very concerned about the debt and the deficit. I was especially concerned this summer. I've been saying for a long time, I won't really care about debt and deficits until the bond market cares, and the bond market seemed to care. But, you know, there's a saying, don't fight the Fed. I think on November 1st, we learned don't fight Janet Yellen at the Treasury. She cut back on the amount of bonds and notes and bond market like that. I think the bond market also liked that inflation's come down. So on the bearish side, you have profligate, out of control fiscal policy. On the bullish side for bonds, you've got inflation coming down substantially. I think we'll be down at a 2%, the Fed's 2% inflation rate target by the second half of the year. I think they were hoping they would get closer to it in 2025.